going to decode a crucial concept, one that really trips up so many investors. We're going to look at the difference between the loud, obvious chaos of market volatility and the much quieter, much more dangerous threat of what we'll call real risk.
So let's just start with a simple scenario. Imagine an asset you own drops 20%. What's your first reaction? I mean, for most of us, it's a gut punch, right? It's fear, and we immediately label that thing as risky. But here's the question. Is the asset itself the problem, or is our own psychology actually what's defining the risk for us? You know, to really understand our reaction, we have to start right here with something called prospect theory. All the research shows that the emotional sting you feel from losing, say, $100, is way more powerful than the joy you'd get from gaining that same $100. And that isn't a market rule. That's just a human psychology rule. And it's this very bias that frames our entire perception of risk. So our first step is just to acknowledge that our perception of risk, well, it's not purely rational. Not at all. It's deeply, deeply intertwined with our own cognitive wiring. You see, price drops don't just happen on a screen. They happen inside our heads.
And this feeling of danger, it's not just one thing. It's really a cocktail of powerful psychological drivers. You've got loss aversion, that's the gut punch we just talked about. Then there's herd behavior, which pressures us to sell just because everyone else is selling. And then you add in recency bias, which convinces us that a recent drop is just going to keep going forever. So when you mix all those together, you get this huge emotional reaction that can completely shut down our rational analytical thinking.
Okay, so this brings us to the first of our two core ideas, volatility. I want you to think of volatility as the surface of the ocean during a storm. It's chaotic, it's visible, and it commands all of our attention. It's the thing we see.
So technically speaking, volatility is just a measure of how much an asset's price moves up and down. A high volatility asset has these wild price swings, while a low volatility one is, more stable. But here's the crucial point. Volatility only measures the magnitude of that price movement. It tells you absolutely nothing about the reason for the movement or the underlying quality of the asset. It's just pure price action.
And this right here perfectly illustrates the two ways of looking at the market. On one side, you've got technical analysis. It's all about charts, patterns, price, and volume. It's the lens we use to see volatility. It's basically asking, where's the price going? But on the other side, you have fundamental analysis. This is about digging into the business itself, its health, its earnings, its real value. And it asks a totally different question. What is this thing actually worth? You see, volatility lives in the technical world. Real risk lives in the fundamental world.
So now let's contrast all that with our second concept, real risk. If volatility is the loud, chaotic noise on the surface, then real risk is the quiet, almost unseen signal that something is fundamentally and structurally wrong. It's what we have to actively look for. And here is the core distinction, really the heart of the matter. Real risk isn't about the price going down and maybe coming back up later. No. It's the risk of the price going down and staying down because the underlying business has fundamentally broken. It's the risk that the intrinsic value of what you own is permanently damaged.
So where does this real risk actually come from? Well, it usually comes from one of two places. It could be internal, things like bad management, failing financials, or losing a competitive edge. Or it could be external. Maybe its entire industry gets disrupted by a new technology, or a major economic shift permanently changes its prospects. Notice that neither of those has anything to do with short-term market sentiment. They're all about long-term business health.
So, if volatility is all about short-term price, and real risk is about long-term health, what's the one factor that separates them? It's time. Your time horizon is the lens that brings either the noise or the signal into focus.
This slide just shows it perfectly. I mean, look at a chart over just 1 month, and what do you see? Pure chaos. It's all noise. But as you start to zoom out to 1 year, then 5 years, and then 10 years, that short-term volatility just fades into the background. The real long-term trend of value creation, the signal, that becomes crystal clear. The exact same price drop can be a terrifying event on a 1-month chart and just an insignificant blip on a 10-year chart.
There's this classic quote that just nails the essence of this entire discussion. In the short run, the market is a popularity contest. It's a voting machine driven by emotion, sentiment, and news headlines. That's volatility. But in the long run, it becomes a weighing machine, where the true fundamental value of a business is what ultimately determines its price. That's where real risk, or the lack of it, is finally revealed.
Okay, so let's put all of this together into a really clear framework. The goal here isn't to eliminate volatility. Because you can't. The goal is to develop the clarity to distinguish it from actual real risk.
This summary table is really the key takeaway. Volatility is the short-term noise of price movement, and it's driven by emotion. The question there is, where is the price going next? Real risk, on the other hand, is the long-term signal of a business's health, and it's driven by fundamentals. And there, the question is totally different. Is the business's value still intact? One implies a temporary fluctuation, the other a potential for permanent loss. See the difference? A price drop in a healthy company is just volatility. A price drop in a failing company, that's the realization of real risk.
And this leads us to the much deeper pattern, doesn't it? The market isn't just a test of your analytical ability, it's also a mirror that reflects your own psychological biases. So the ultimate challenge isn't really forecasting the noise of volatility, it's mastering your emotional response to it so you can stay focused on the signal.
So the next time you see a price fall 20%, the real question isn't whether it's risky. The real question is, are you seeing the temporary noise of market fear, or are you seeing the permanent signal of a business in decline? That distinction is everything. If you want to continue decoding the unseen patterns that shape our world, be sure to subscribe to NeuralTarot. We'll see you next time.